Is Tuesday, 27th of September, year of our Lord 2022, and we are about to go live with another lesson in personal finance. I'm going to jump over into the Zoom meeting now and get it started, and we will admit the students who are in the waiting room. Welcome. Welcome. If you're joining us in the Zoom room, welcome. If you're on Facebook or YouTube watching the live stream, welcome. Please leave a comment. Let me know you're listening or watching, rather. If you're in the course, that's part of what we're looking for. It's kind of how I take attendance, is just you leaving a comment. So, hey, David, thank you. And let's see if I can take a gander at the chat box. Karen, Emma, Louise, Lewis. Is that Lewis? Louise, Sahil, man, good to see you guys. Welcome back. This is week 2 of Credit Crush assignment. So we're going to pick up kind of where we left off and continue moving forward with the Credit Crush assignment. One of my favorite assignments. I think I mentioned last week that my favorite assignment is the First Memories of Money and reading your interviews with your parents, the parental interview. And that is my favorite. Hey, Dante, good to see you, man. Glad you could join us today in the Zoom room, the Zoom meeting. And good morning to you. Good morning, everyone. I appreciate that. Dante, I think you're like the first person who said good morning, everyone. Believe it or not, it's like, I don't know what it is. The engagement level in the Zoom meetings is somewhat disappointing. So feel free to kind of chat with one another in the Zoom room. And if you're watching again on Facebook or YouTube, this is being streamed live. The video for today's lesson will be in the playlist in your Money Study Group YouTube channel, YouTube playlist, and also posting it live to missionalmoney.com. So we're going to get started. We're going to talk about the Credit Crush assignment again. You guys, the first week, the first part 1 of this assignment really is pretty simple. You were asked to go out and do some research. Let me pull up that assignment. So the Credit Crush assignment, we set the table with Billy and Sally. Billy being the guy that owned the Ford F-150 pickup truck, and Sally being the person that he met at the Firestone station where they interacted from a consumer to professional relationship that went then to a personal relationship, as I think I mentioned. At any rate, they set the table for our assignment, and I'm going to jump into Billy's plan here in just a minute. Sorry about that. I think I just went to someone else's. Okay, there you go. You shouldn't see those other clients. Sorry about that. So I'm going to jump into Billy's plan here, and we're going to do some work. I think I was already in Billy's plan. Anyway, we will jump into Billy's plan in a minute. It's about 10:04 a.m., so I'm about to get started. I'm going to give everybody a minute to join the Zoom room. But I want to start off with an announcement. I'm going to show you in this assignment. Looks like Shelby is logging in again. Hey, welcome, Shelby. So in this lesson today, you're going to get the answer to the assignment, like the most important screenshot. I wanted to highlight that. But first, I wanted to mention that we have you have an opportunity to earn some extra 50 points and get a free meal, or at least some food. I'm not exactly sure what they're going to feed us this Thursday night, September 29th at Melcher Hall in room 140. It's called Track Night. So what we do, we have the Bauer Finance Association, and they're the ones hosting this. But track night is really about we take different industries and we bring in panelists. Some panelists are academic, others are from the professional arena, entrepreneurs, business owners. And so I will be on the panel this Thursday night. Track night is focusing on the financial services industry. So it's my privilege and my pleasure to talk about what I see as the opportunities in the financial services industry, specifically in the wealth management, personal finance areas. So we'll have folks from around the financial services industry speaking in the panel, but I'm really going to be there to talk about what I see as, you know, I posted about financial coaching for financial advisors. And so if you jump onto missionalmoney.com, you can read this article. And basically, I talk about the process that I use to do financial planning and financial coaching. And so I'm inviting financial advisors, especially young financial advisors who are just getting started in the business, to join me in doing basically the same thing I'm teaching you to do, which is build a financial plan. So I think I say in this that financial coaching for financial advisors, it's important because 98%, and I make up statistics as I go. So, I mean, I don't know what the real statistic is, but imagine how many financial advisors are in the business. They're licensed, they're selling some kind of financial services. I say 98% of them, from my experience in the business, are selling some kind of financial planning. So they're promising in return for your trust and your services to do some kind of financial planning. And so if you look around and just Google financial advisors, you'll see that that's like the first thing that we offer. And we say, let's do that. But the truth is, in my experience, very few financial advisors actually have a financial plan. And that may be surprising. It may not be, but I do a lot of coaching for financial professionals, and I've done that ever since I've been in the business. And it seems to boil down to the reality that, you know, it's a tough business. Every business is tough. Getting started is tough. And when you're getting started in your career, one of the things that happens regardless of your career choice is, you know, you have a lot of needs and wants and wishes, but you don't have as much revenue or income or savings to be able to support your habit, spending habit. And that's true with financial advisors, especially financial advisors, folks like myself who are good at selling stuff, or at least we think we are. And we pursue a career where we're involved in selling stuff. And believe me, the financial services industry is working overtime to try to find and attract and lure in folks like you to come and help them sell their services. And so when that happens, the industry as a whole, you know, it employs a whole lot of people who are kind of desperate to make the sale. So think about that for a minute. If you're working with a financial advisor who's really kind of like every other financial professional or every other sales professional, no matter what business you're in, you're trying to make that next sale, right? I mean, you guys are targets of people who sell stuff, just like Billy and Sally last week in our example. So I believe sales is one of the most noble professions there is. And I certainly believe that financial planning, financial services in general is a very noble career. I mean, you're able to help people. So that's what I'm going to be talking about Thursday night, is the tremendous opportunity, but kind of behind the scenes, what I'm passionate about doing, what I'm kind of a missionary about, is to help financial advisors have some integrity in terms of what they're selling by actually, you know, eating their own dog food, if you will. to have a financial plan if you're a financial professional seems like a pretty good idea. So that's what I'm doing in the next kind of season. There are a lot of reasons to do that. I have my own business, and I'm trying to find and hire and develop the talent that will take over my business when I retire. And everybody else in my situation in this business is, and my age level, is doing the same thing. We're looking for young people who have the right stuff to serve our clients, and so that we can transition into retirement and transition the business and the equity and the ownership to the younger talent. And to do that, you need to learn some skills. The good news is for you is that what you're learning in personal finance is exactly what you need to learn to be a professional in this business. So I'm pretty excited about that. I'm really excited that I get a chance to speak. And so I'm giving you 50 points. If you want to attend, you'll get a chance to, shake my hand or give me a high five or just wave. I look forward to being there. I always look forward to live events. I'll probably sweat because I do that when I get nervous. No, I don't think I'll get nervous. Hey, speaking of sweating, today was 64 degrees when I got up to go for my walk. I'm so excited about winter coming. Anyway, okay, back to the course. Now it's 10:12, so we are moving forward. We are on. And I'm assuming you can hear me because nobody's said anything in the chat that you can't. So thank you very much, Nan. I appreciate that. I try to do. Say that again. Did you ask? Yeah, to get the 50 points, you have to actually go to the event. I don't think they're streaming this event. I thought about taking my laptop and camera and streaming it myself, but it's not my event, and I don't want to get in trouble. Yeah, yeah. Melcher Hall is one of the big buildings on campus. It's in room 140, I believe. Yep, 140. And you bet. And don't forget, they're going to feed you. I don't know what we're going to eat, but hey, free food is always nice. And there'll be more of these. And I try to always announce them and give extra credit if you can attend. But anything related to financial services, and anytime I'm going to be invited to speak, I try to always make it available to my students to get extra points. And since we're teaching an asynchronous course online, it just is an opportunity to get to meet each other, and I'd love to meet you. So if you can make it, great. You do get 50 points if you attend, and then, give me a little bit of a snapshot of each of the speakers' notes, just what they talk. Have an accounting in Melcher Hall. If anybody needs help getting there, let me know. Thank you very much, Stan. Stan's offering to give you directions. Okay, back to course. So I'm going to jump into Billy's plan and just show you what we're working on with the Credit Crush assignment. Um, so the first thing I want you to know is I posted, just to make it simple, the most important screenshot. So when I grade this assignment, let me just show you what I'm looking for. And I'm going to show you how to do this here in just a minute. But if you're still trying to figure out how to get around your financial plan, navigate and do things, it's time for you really to get comfortable moving around in your financial plan. And I'm going to show you here in a minute how to create a screenshot that will get you full credit for this assignment, part 2 of Credit Crush. So the first part of the assignment was you were going to build, you had to do a little research, remember, and come up with a reasonable amount of income that you could expect if you get the job that you hope to get when you graduate in the field that you're studying. So that was really the beginning. And from there, we're now creating a financial plan for you that's in the future. So we're using some assumptions. And one of the assumptions is the assumption of your income. How much are you going to make? How much can you realistically expect to earn once you graduate and get a job in your field? That's number one. Number two is the same thing is true for expenses. And my experience with this course and the students in this course is that you really don't have a good idea about the level of expenses that you're going to have in your life, because some of you do, some of you have a very good handle on what it costs to live, but the majority of you don't. And the majority of you have been living on someone else's dime, and you still are. And because of that, you don't really have a good sense of what your expenses are going to be. And because of that, your financial plan is hitting those high probability of success numbers, because you're not putting enough expenses into your life to meet what's going to be reality. So that's just commentary from my perspective based on my experience teaching this course for over a decade. So you may or may not fall into that category, but I want you to be aware that that category exists, and you very likely may be in it. So what to do about that is to just be a little bit more diligent about the research that you do related to expenses. And so last week, part one of Credit Crush, I asked you to do the research to come up with your assumption for income. But I also asked you to go back and take another look at your expenses. And I asked you to do three things, to add three different expenses to your plan, which means you had to build three different data cards to reflect each of these elements of expense in your plan. One was you're going to buy a house. You're going to do a little research and find out, where do you want to live and how much is a house going to cost that you can afford based on that first piece of research, your income. So that was the first thing. You had to create a mortgage data card. And so you did that. And the second thing was you were going to purchase a car. So you were going to find your dream car, the car that you always wanted, and you're going to buy it. You're going to have to build a data card. So you all did that. And the third piece was to just go out and spend some money on a credit card. And now that you have those three pieces of debt in place, it's time to go back and take a closer look at them. And now part two of the Credit Crush assignment, we're going to actually attack that credit. And what I mean by that is we're going to look at some different debt strategies that you can use to pay off your debt. And they're very simple, really. And once you've done the homework, once you've built those three data cards, your mortgage, your car payment, and your credit card, you'll see how easy it is to go in and make changes. So now I'm jumping into Billy's plan. So you're seeing Billy's plan, and sorry about that. I don't know why Billy's plan doesn't want to stay up. Let's see if I can make this work. I'm using my new iPad Pro. It's over here. My thumb is on it. So you should be able to see what I'm seeing, which is I just jumped into Billy's plan. Now I want to spend just a minute doing a little navigation in Billy's plan, because I know that some of you have just done your way advanced. This financial planning platform that we use, it's from Right Capital. As you can see, app.rightcapital.com, and I am logged into Billy's plan, and you will be logged in to your plan. But that's the company that I use for financial planning. You also see that Bayrock logo because that's the name of my company. So that's where we are right now. So I want you to just pay attention to those upper tabs for a minute. So you see dashboard, investment, retirement. If you think about really the main places we're going to work as we develop and create your financial plan this semester, in those upper tabs, you've got dashboard to the left, and you've got profile to the right, and you've got retirement there kind of in the center. So if you'll just like tattoo that on the inside of your eyeballs so that you don't even have to be in your plan to know that when you go to dashboard, first thing you're going to see And then you look at the lower tabs and you see all the way to the left, you have snapshot. And the snapshot is just an overview of your plan. And I can adapt this and make it, personalize it. I don't typically do that for you because but for clients, I mean, I can make any data card in your plan pretty much can be represented in your snapshot. I just want you to be aware of your snapshot because when you review your plan, when I review your plan, it's just super easy for me to jump into the snapshot and see your probability of success, your net worth, and a bunch of other things. And like I said, I can tailor this and customize it for any plan. Billy and Sally, as you'll see, they're a little older than they were when we started. When Billy got into debt, they've got an inheritance, they both have jobs, they're making good money, yada, yada, yada. So as I look at their plan and you look at their plan with me, you'll see that it's a little bit more mature, their plan, because they're a little bit older than you are. And so, well, not all of you, but for the most part, this is not a college student plan. This is a plan 10 or 15 years later. So this is what I'm asking you to start to create for yourself is an imaginary plan based on 10 years from now. We're going to change your birthday in your plan soon. You don't have to do that yet, but you're going to do that so that you're going to pretend that you're 10 years older. That's coming up in future assignments. But for now, we're looking at Billy's plan. Dashboard to the left, you got snapshot, balance sheet. You see all of those things, including debt. So we're going to come back to that. I'm going to hit the debt. So how did we get there? We were at dashboard and we went to debt. So that's where we're going to go to play with the debt strategies. And if I wanted to, just a few minutes ago, I added a credit card to Billy. I added Firestone tires. So I just added that in his plan so that I could illustrate this assignment real quick here. So now I'm just going to show you how to get, remember, we're trying to get this most important screenshot. That's what we're looking for. That's what you're going to do. You're going to create this screenshot. So I'm going to show you how to do that. So back into Billy's plan, we go from dashboard at the upper tab to debt. And when I click on that, I see this screen right now is what I want you to pay attention to. So there are 3 tabs: strategy, payment, and details. I want you to know what's behind those tabs. And then there's this action items. I want you to pay attention to the action items because that's really where you're going to start to apply a debt strategy for paying off your debt. So that's what I want you to learn. I want you to learn how powerful it is to apply different strategies to pay off your debt. And I'm going to use Billy's plan to show you, but you're going to have to do the same thing in your plan. And the main thing I want you to see, I mentioned this last week when I told you Billy and Sally's story. And I told you this story I told you some of my story about my experience with credit when I got married. I've been married for, a long time. But when I got married, I had a lot of things I wanted to buy, and I bought a lot of stuff. And my wife, who is much more frugal than I am, she doesn't spend money like I do. She's very frugal. And I would buy things that I wanted, like new furniture, like a new TV, like a car. I would buy things on credit because credit was available. I mean, in fact, I remember buying some kitchen dining room furniture, and I didn't really buy it. It was from one of those rent to own places. A terrible, terrible idea. And I remember we got in trouble financially. We were in bad trouble. Because of me, because I was a maniac with spending, and I was putting things on credit, and I was just too stupid to know what I was doing. And my wife, who was frugal, she was feeling more and more and more anxiety and stress because she's married to this guy who's not really paying attention to the financial situation that I was putting us in. And so one day, after being separated for 6 months, my wife sat down and she said, I want to show you something. And she pulled out a credit card bill, a statement, and she showed me what I'm about to show you. But it was a different format because we didn't have internet back then. We certainly didn't have financial planning software like you're using today. But she was able to show me how our credit card bill had a balance and an interest rate and a minimum payment. And we were paying the minimum payment, and the balance, because of the interest rate and the fees, the balance was going up and up and up, not just on one credit card, but on several. And she just showed me how if we keep going down this path, we're already buried in debt. We're going to get just bombarded. And I couldn't believe what she was showing me, that I was so stupid to fall into that trap. But it is a trap. It was a trap for us. But once we realized it, and once I got angry and determined, like, how did I make such a dumb mistake? From that point, it was a lot easier for me to have a plan and execute that plan with a high level of intensity, with a sense of urgency and focus and purpose. And that's what I want to happen for you. That's why we spend 2 weeks on an assignment that I named Credit Crush, because I want you to crush your credit. So that's what we're about to do. So remember, you've got action items, strategy, payment. When I hit on payment, it's going to show just a summary, like you did not long ago when you did your credit report. You created a summary, a list of all your creditors. That's what you have here when you click on payment. And then we have details. Now, I want you to notice under details, you can open each of these specific things. So your car, your mortgage, your credit card. Just know that you can filter down like that. So here we go to Billy's. This is Billy's credit card. So I'm looking at my screen and my thumb is working my iPad. And I just want you to pay attention because this is what my wife showed me. By the way, my wife asked me this morning, she always asks me on Tuesday, what are you teaching today? And I told her, and I told her about Credit Crush Part 2. I told her how we set it up for Part 1 and how we're doing Part 2. And she's like, it's such a snare. She said, credit cards, credit, it's such a trap, especially for young people, she said. I'm like, yeah. And kindly, she didn't remind me that I used to be a young person and I made the mistake. I fell in the trap. This is the trap. So remember, Billy, he had this nice pickup. He went to buy some tires at Firestone, had a coupon, ended up getting the better tires because Sally sold him on a better set of wheels and tires. And he needed an alignment and he got the warranty. And they made it so easy. 6 months, same as cash. The total bill was around $5,000. So this credit card that I set up for Billy was a $5,000 balance, but he didn't pay any of the payments. So now we're 6 months later, and so he has extra balance on there. His balance went up. So these numbers may not be completely accurate, but they definitely work to illustrate the point. The point being that Billy has a balance. He has an interest rate. I believe the interest rate we set up here is 18%. Let's check. Go to profile, go to card, go to Firestone. Yeah, we set that up as 18% with a fixed payment, $5,500 balance, $35 minimum. So that's what we did. We hit save, and then we go back over to dashboard, and we go to debt. That's where we're going. My iPad is going slowly, so I could easily fast forward this if I was in the middle of a video editing deal, but I'm not. This is live. So here we go. So we're back to the debt. This is where you're going to do your work this week. So we're back there, and we have details, and we have the Firestone tires and this credit card account. And what I want you to notice on that right, the ending balance. So these are currently annual. Let's click on monthly. See how I clicked on annual and monthly? You can just go back and forth. So let's just look at monthly. This is what I always try to illustrate when I teach the Credit Crush assignment, but it's a little difficult to do the math. So this software, your financial plan will do the math for you. And what the math is showing you is that Billy's paying $35 a month, which is the minimum. The interest is $76 a month. And again, these numbers, this may not make sense. This may not seem normal to you. You may say, oh, there's no way. There's a way. They do it all the time. But that doesn't matter to you. This illustration doesn't really matter to you unless you have a credit card and you check your own credit card statement to see what you're paying in terms of interest. And that doesn't even include fees, but just interest. The interest higher than the minimum payment always produces a balance that instead of going down, it goes up. And when the balance goes up, the interest payment goes up. So just look at that. So that's what we're first just trying to be aware that that's how credit works. And that's how they get you, is they give you this really easy to get loan where the payment is super low. And you think, oh, great, I can afford to buy more. Yeah, that's how they get your money in their pocket. And the end of the day, your payment isn't even paying the interest and your balance keeps going up and you get more and more and more buried in debt. That's how it works. So that's Billy's Tires. So now we're going to go back to, we've got payment. Again, that just shows all of them. We go to strategy, and here's what I want you to think about. Now, one of the things we could do is just change the strategy. So there's 3 different strategies. One is we pay all the debt off in the same, we attack it with the same level of intensity. We don't have any strategy, really. We just pay the bill as it comes. That's what Billy's doing now. So what if we change that to the highest to the lowest interest rate? Does that make any change? Doesn't. I have to hit refresh. Let's see if that does anything. It doesn't look like it. Oh, it does something. So it says, oh my goodness, if we just change the highest to lowest interest rate, look at what a difference that makes. It's like, wow, $50 million. And that may seem ridiculous, and it is ridiculous. It seems ridiculous to me that $50 million over a lifetime and 542 months sooner. But you'll see that Billy and Sally have really gone way overboard in terms of spending on credit. And they haven't been very smart in how they, have their credit set up. So there's a lot of low-hanging fruit here. So let's just go to details now, and let's go to payment and see. So you see here, this is what you're going to see in your plan. You're going to see, maybe you can see it. Can anybody see it without me pointing it out? What changed in this plan? Go ahead and, if you're watching on YouTube or Facebook, just put a comment in. What changed in Billy's plan and their debt management just by changing that one strategy from same priority for all debt? That's what we did. I'm going to hit refresh again just to bring it back to the baseline. So we have no change. Right here, we're looking for total savings of how much? And how much sooner will we get out of debt? So we have basically no strategy in place. We have the same priority for all debt. But if we change one thing, highest to lowest, and don't forget to hit refresh, then what happens is we have this massive amount of savings. So when we jump into payments, what do we see? Come on, guys, give me a little bit of help here. Put a comment in. What do you see changing? It's going to, these are just as This is Billy's plan. These are all of his debts. And if you look at the balances and the interest rates and the minimum payment and the current payment and the proposed payment. So the current payment is we haven't done anything to Billy's plan. You haven't done anything to your plan to make any change in debt strategy. And so it's the current payment. That's what it is. But then the proposed payment is based on what did we just do in terms of applying a debt strategy to crush Billy's credit or your credit. And that's where we look at that column and we see the proposed payment, which is what is creating this change in the plan. So can you see it? Anybody? I don't see anybody commenting in the Zoom room, which tells me generally that you're probably watching Netflix, or maybe you're on Facebook, or who knows. But hey, if you're watching, the proposed amount ? Tika, so what is the proposed amount? What has changed? I need you guys to understand what just happened. Someone, hopefully someone who's watching right now recognizes what just happened. I'm going to tell you what just happened, but it would be really nice if you were like, oh, yeah, that's what happened. So I see 152 is now 3,000. Yes, that's what happened. So when we changed the strategy, this financial planning software that's really super smart, it said, we're going to go and we're going to find all of your debts, and we're going to pick the one that has the highest interest rate, and we're going to pay that one off first. And so we're going to reallocate the money that you spend in paying your credit cards and all of your credit. We're going to reallocate that, and we're going to use more of that payment to pay off the one that has the highest interest rate. And so the result is, instead of paying $125 on the Sally's Wells Fargo Visa, which was $24,750 with a 16.75% interest rate, the computer, the planning software said that's the one we're going to attack. That's the one we're going to crush. And by doing that, you can see, if you go to details, we can see that Sally's Wells Fargo, instead of it going on and having the balance go up and up and up, because she's paying a minimum payment and the interest is much higher than the minimum payment, so the balance keeps going. Instead of that happening, she's actually knocking this thing out in just a couple of years. So that's what happened. So that strategy is working, and that's how it's working. It's finding and attacking the most offensive credit that they have in their life. And that's what I want you to do. So that's what you're going to come up with, is you're going to play around with your debt strategy, and you're going to find out what happens. Now, here's another thing I want you to think about. Yeah, Elisa, the answer is, your question is, so we pay the one with more interest first. That's what this strategy is doing. And it's saying, yeah, that's the way you're going to maximize your dollars for paying off your debt. Instead of just paying it off equally, you're going to pay off the one with the highest interest rate. There are a couple others, though. You could do the lowest to highest. Let's see what happens when I hit refresh. So that still does about the same thing. It looks like exactly the same thing, maybe a little different. But if we want to see the details, let's go to the details. Let's go to the payment, actually, and see what happens. So it's paying off the lowest to the highest. So what happens is, you see right here, instead of paying $35 on the tires, it's paying off $5,500 in a year. I think it's annually. So that's a different strategy, but this is the strategy. Let me talk about this strategy for a minute. So what we did was we said, okay, we're going to pay the lowest to the highest balance. Now that's a strategy, and it turns out that this strategy and the highest to lowest interest rate, those are two different strategies. They're both way better than paying the same priority for all debt. But what happens when you pay off the lowest to highest is your money works much more effectively for you because you're totally eliminating one creditor. You're paying the lowest one off and then it's gone. And then the computer's smart enough to take that same amount of dollars that you're already spending on your debt, and it's now using a different percentage of that for the next lowest. Dave Ramsey calls this the snowball effect. So if you've ever heard of the Dave Ramsey snowball effect, it's a powerful strategy because of the psychology behind it. Now, clearly, it's a much more powerful strategy from a technical financial planning perspective, as you can see right here, because it has this impact on the financial plan. That's clearly technically working effectively, right? But what really makes this work, the lowest to highest balance, and the reason Dave Ramsey promotes this as one of his, it's kind of part of his baby steps, but the snowball effect, and I wrote about it in my book, it's the psychology of the snowball effect goes like this. You decide, like I decided when my wife helped me see how we were getting buried in debt because I was dumb. That's really what happened. I was dumb. I made some mistakes. I got in a situation where they were absolutely taking me to the bank. And so we decided we were going to get out of debt. So the way the snowball effect works is you pay the lowest one first because you get almost instant gratification. You get to watch that lowest balance get smaller and smaller until it's gone. And when it's gone, then you just move on to the next one, the next smallest, the next one that's on the list. And so in this case, what we're doing is we're looking for these balances, and we're going to pay the balance off of the lowest one, and then we're going to go to the next one, and then the next one. And that's what we're going to do. And we're going to keep doing that. And it's going to be remarkable how quickly you get those debts paid off. But what happens is you have a psychological effect of just seeing results, the endorphins that come when you can check something off your list and move toward your goals. The endorphins, the kind of euphoria, the good feelings that you get in your life from doing that and making that kind of progress is remarkable. It's a psychological impact that is just powerful. And so it's not that it's perfectly, technically better, but if it affects your behavior in a good way, it's a good thing. And so I just want to kind of highlight this strategy is, it's a powerful psychological strategy, but it's also very effective. And you can see that here. So you're going to have to figure out which one of these you want to use on your debt. You've got your mortgage, you've got your car, you've got your credit. You may have some student loans. If you haven't already put those into your plan, why haven't you done that? I mean, seriously, it's your plan, it's your life, and you should be now at the point in this course where you're recognizing that it's not just about using a financial planning piece of software, financial future, and how can you make smarter choices with your money. And that's really what I'm trying to teach you, and the Credit Crush assignment is all about that. And so even though this debt may not be real for you, it will teach you the importance of managing debt. And it might help you help someone else in your family or a friend or maybe a future spouse, like my wife helped me, recognize the dangers of being buried in debt and how it happens and how to get out of it. So hopefully that helps. Now if you have any questions, now's a good time to post those and ask those. I think I've covered pretty much what I wanted to cover. Oh, there is one more thing that I want you to play with, that I want you to test in your plan. And that is right now, Billy and Sally, they're paying all minimums. So if I go back to same priority for all debt, hit refresh, and then I'm going to jump into payments, and you're going to see that they have a minimum payment and a current payment, and they are all the same. Except for what? This is the Wells Fargo cash. That's actually my credit card. That's crazy. I don't know how that got in there, but that's a real credit card, and I pay it off every month. So anyway, that shouldn't be in this plan. I was playing. So anyway, if you look at their debts, all of them have a minimum, and the minimums are being paid. I'm not sure. Thistlewood, that's a house, that's a mortgage. And that's the minimum payment. But you're going to have, in your plan, you're going to have the same kind of summary. But here's what I want you to look at. Here's what I want you to play with. Instead of that being a 0, this is the proposed additional monthly payment. If you get really serious about paying off debt, then you should say, I want to actually spend, how much more per month could you spend if you wanted to really get serious about getting out of debt? How much more could you spend? So let's just say that Billy and Sally decide they want to spend another $550. And then we go to refresh. Let's see what happens. With nothing changed in terms of strategy, same priority, look, they save $24 million just by paying $550 more. And if we go to payment, we see a minimum payment and then a proposed payment. And what happens is each of these payments, because we're using the same priority, each of them gets increased a little bit, and it has an impact on the plan. And you can see that. You can see that strategy's going to save over the life of the plan $24 million. That's significant. And remember, we have a whole bunch of debt here for Billy and Sally where they're paying minimums and their balances just keep going up and up and up into perpetuity, which means they'll never get paid off. They'll continue to be more and more and more buried in debt. That's the point. So now let's look at the strategy, and instead of same priority for all, let's change that. Instead of same priority for all, let's go to highest to lowest, and don't forget to hit refresh. Hit refresh and see what happens. Then we get this. We saw this before, but it's hopefully even better now that we have an extra $550 a month. But the truth is, if we're paying the highest to lowest, it doesn't change it that much. The $550 isn't nearly as big of an impact on the plan as simply just paying off the highest interest first, because that dynamic produces remarkable results. The point of that is, there's no reason why you wouldn't want to take a strategy that isn't even going to impact your quality of life or your cash flow and just do that. That's what financial planning, it's why it's so powerful, because you look at different strategies where you don't even have to really change your lifestyle. You just do something smarter and you have a way better result. I call it smarter strategies and better results. It's not rocket science. It's very obvious, but a lot of people, and I was one of them, just didn't realize, we didn't know what we didn't know, and that was dangerous. And so I want you guys to know how this works. So that's that. If we go to payment, now we can see how we're doing the highest interest rate to the lowest, and you can see how that changes the proposed payment in Billy's plan. So that's what you're going to do. You've got details over here. Again, if you want to jump in and take a closer look at any of those, you can do that. So that is the Credit Crush assignment. And again, I posted this in on Missional Money. And this is, I think this is also, if it's not, I I know I posted it in a money study group, and it's just a short article that tells you what I'm looking for when I grade your part 2 Credit Crush assignment. It's the most important screenshot. So if you have a screenshot similar to this, similar to what we just talked about, that's the goal of this assignment. In addition to that, I'm looking for you to tell me what you learned, what you learned about changing things up in your plan and applying these different strategies. So Tika has a question. On the detail page, if using a student loan, is it correct that it includes a 6-month grace period and then increases tremendously after about 13 years? I would have to look at your plan, Tika, to see if that's correct. But just like anything, I mean, your plan, what you put in your plan is what's going to be represented in the data. So if you entered it wrong, then it's, I mean, you could easily like look at Billy's, if you look at Billy's plan and any of the credit that he has in his plan, it just goes absolutely crazy high, which is why when we make these changes, we have a ridiculous number, $50 million savings in one family's financial plan. That seems ridiculous to me. But it's because we have a ridiculous amount of debt with paying the minimum, and the balance just keeps going up. And when you do that over time, 13 years is a long time. If you have an 8% loan and you're not paying anything on it, and you're paying the minimum, you've got that 6-month grace period. And just like what happened with Billy's loan, you have to look at your student loan and see if that grace period means you're not accumulating interest. You probably are. You just don't have to make the payment until you have a 6-month grace period. I had a much longer grace period than that on my student loans, I think, but you got to look at the loan. I can't really answer your question. It's a great question though. Thank you for asking. Yeah. It's so you said it's accumulating interest, but no payment until whenever you make the payment. So yeah, if you put it in your financial plan and you don't start making payments, your plan is just going to take that balance and make it go higher and higher and higher. And that's, like I said, what's happening in this financial plan with Billy is there's just all these debts that are getting minimum payments. So I'm going to change this back to same priority for all debt and just show you. I got to hit refresh. And it didn't look like it took. But at any rate, if you look at details, or you just look at this, you can look at this chart and see how much debt there is in the plan, and your student loan will be in this. Now this is showing the aggregate for the all of the debt, but if you just had one loan, you'd be looking at that one loan going up, and so that's how that works. So hopefully that helps. If you want more help, let me know. You bet. I think I'm going to wrap it up there. It's 10:54 a.m. Last week I kept you a little long, so this week I'm going to try and let you go a few minutes early. I hope you guys can make it Thursday. If you can't make it, no problem. But if you can, I'd love to see you. I'd love to know I had some friends in the audience. So, and you get 50 points. 50 points. I'll wait until I see a student. If nobody shows up, then I won't post the extra credit assignment. But if you do show up, then I will. Today, I'm going to post Credit Crush Part 2. That'll be in your Blackboard queue here in the next hour or two. And I still need to grade the work that you guys submitted last night. So I will be working on that today. And I'm going camping at the end of the week, so you'll get your extra points if you turn your assignments in Friday by 3, but I may not be able to grade them because I may be camping where I have no internet. So just so you know, FYI. Thank you guys for being here. I look forward to seeing you next week, and good luck with the Credit Crush assignment. I am going to take my mouse and I'm going to end the Zoom meeting, and then first I'm going to end. Somebody's trying to call me. I hate it when that happens. I'm going to end the broadcast. So if you're on Facebook or YouTube and you're watching the live stream, thanks for being here. Don't forget to put a comment or two. Let me know you were watching. If you're a student at the University of Houston, I appreciate that. And I'll see you next week. Take care. I'm going to end